This is David Ranson. Welcome to HCWE's webcast for the month of November 2023, and the theme is the predictable normalization of energy prices. Conventional methods have great difficulty in forecasting the price of crude oil, but there is another way. Oil prices have both a real side and a monetary side. But the shifting geopolitical supply and demand imbalances and uncertainties that push it back and forth on the real side and preoccupy forecasters are not lasting. Oil, along with the prices of other energy products, contains a lasting and systematic element of predictability that is obscured by its random and sometimes violent volatility. Over time, it is the monetary side that dominates, and it is surprisingly recognizable. The oil price is constantly on the move back toward a variable equilibrium or norm, determined by inflationary forces unleashed as the value of the dollar varies in money markets. The purpose of this presentation is to show how the equilibrium price of oil can be tracked with precision day to day from gold and long government bond prices. In the long run, a country's inflation is commensurate with that country's currency depreciation. The history of high inflation countries in Exhibit 1 shows inflation to be proportionate to the currency's loss of value relative to gold. Gold is an excellent benchmark because its purchasing power varies less over time than anything else. The chart implies that any currency that stays fixed in terms of gold can in the end have no inflation. In the short term, appearances are very different. Exhibit 2 compares the influence of energy prices, epitomized by crude oil, with the role of Fed interest rates in explaining inflation. The delay in the Fed's effect is allowed for by using a one-year lag. No lag is needed for the oil price. So we get four scenarios, and they're shown in Exhibit 2. They enable us to see what really counts in controlling the inflation rate. Inside each quadrant is shown the deceleration or acceleration of inflation for that scenario. The four scenarios appear in the four quadrants, measured by both the Producer Goods Index and the CPI. It's obviously the price of crude oil and not the Fed that matters. The volatility of monthly fluctuations in the price of oil are sometimes extreme. Exhibit 3 shows how true that is today. Yet markets are efficient enough to maintain a close parallel between the two primary price benchmarks, Brent and West Texas Intermediate. The force keeping this parallel in place is arbitrage. Visible over tougher horizons, there is also a parallel with the price of gold. Especially when the dollar's value changes dramatically, the price of oil moves in concert, as shown in Exhibit 4. This suggests a means of forecasting the price of oil that does not depend on identifying and judging the details of supply and demand, and by extension, a means of forecasting the prices of other goods and services, and of inflation generally. Oil price movements fall into two categories, predictable and unpredictable. When the oil price moves back toward restoring its normal ratio with gold, that is a predictable part of its behavior. When the oil price is pushed around by other factors, that is unpredictable, and in the end, temporary. This makes the oil-gold price ratio an extremely important statistic. It is pretty stable over long periods of time, roughly equal in recent years to what it was 75 years ago. Exhibit 5 shows the frequency distribution of the annual average oil price ratio. It's a bell-shaped curve, clustered around a mean of 0.08, which signifies 12.5 barrels of oil for for each ounce of gold. It sometimes diverges quite far from that mean, and it might make sense to use instead the median. Either way, the mean or median can be used as a norm for the purpose of medium-term forecasting, because of the observation that when disturbed, the ratio comes back. To complicate the story, we cannot assume that gold will be an exactly constant asset in the short term. That's because, like government bonds, it's a highly desirable asset in times of unusual economic turbulence, and relatively undesirable when uncertainties have abated. The price of gold in sufficiently distant forward markets should be immune from these safe haven departures from the norm. And Exhibit 6 shows a 100-year history for spot gold, 20-year forward gold, and crude oil. All three move in broad parallel, but it can be seen that the parallel between oil and forward gold is even closer than between oil and spot gold. The ratio of oil to forward gold varies even less than oil to spot gold. It's not quite a natural constant, but the frequency distribution of its annual average, shown in Exhibit 7, is tight. Deviations from the median, which is 0.027, are quite limited. Still, there's more. We can still do more. On further study, one more adjustment is worth making. The distribution has drifted very slowly to downward over the last 75 years, very slowly. So another estimate of the norm is the median, not for the whole 75-year period, but for the past decade or so, and that is 0.024. Let's therefore assume the normal ratio of oil to forward gold is somewhere in this range, 0.024 to 0.027. From that, we can calculate a norm for the oil price itself, around $120 at present. In Exhibit 8, the oil price norm is compared with the actual price since 2016, and as expected, the actual price gravitates around the norm, which of course itself is changing over time. Currently, the oil price at about $75 is far below the normal range shown. Of course, the forward price of gold is itself unstable, adding to the instability of the oil price. Exhibit 9 shows how 30-year forward gold has risen and varied in wave-like fashion since the end of 2020. We see a cumulatively enormous depreciation of the dollar, more than 50% relative to forward gold. The strong upward trend in the data also imply further rises in oil prices beyond the $120 level. I now want to introduce my colleague and friend, Frank Kane, who will ask me some carefully thought out questions, and then I'll provide my responses. Frank.
David, recently there have been some articles in the press and some chatter from market analysts that seem to be on both sides of a debate about the role of the Fed in, quote, taming inflation, unquote. What's your point of view on the impact, if any, of the Fed's higher interest rates and shrinking balance sheet versus the improvements that we've seen in the supply side of the economy?
The Fed's impact on inflation is a belief derived from a theory popularized by one school of thought, but rejected by others. According to its central bank doctrine, inflation results from too much demand and too little supply. Higher interest rates curb demand, holding growth back and thereby taming inflation. But the absence of evidence that this actually happens, as shown in Exhibit 2, in fact it's evidence that this actually does not happen, tells me that the theory is wrong. My opinion is that no economic belief should survive in the complete absence of compelling evidence in support. The strong correlation in Exhibit 1 meets this test and points to currency stabilization as the right way to curb inflation.
Some of us are getting confused by the signals we may be seeing in the markets these days regarding inflation expectations. It feels like interest rates are higher, gold prices are largely unchanged, and some inflation-related commodity prices are even lower. What's the market really telling us about inflation rates going forward?
Several factors are involved, and they are not necessarily in equilibrium. One dominating factor, at least in the shorter term, is the price of energy. If the economy were in an equilibrium state, we could simply use the price of gold as a measure of current inflation. The level of T-bond yields would be a measure of inflation expected in the future. But in the present context, the inflation trend is heavily influenced by energy prices, which according to Exhibit 8 are presently depressed. The oil-gold ratio is currently far below the historical average. The ratio of oil to 20-year forward gold has also fallen far below its normal range of 0.024 to 0.027, as shown in Exhibit 9. That's why inflation has decelerated over the past year or so. Over time, these oil-gold ratios always come back to equilibrium, and that requires a very large move in energy prices. Expectations of inflation should therefore be high, supporting the message from the bond market.
We've seen some stunning, though preliminary, estimates of the federal budget deficit for the 2024 fiscal year. There was a time when balanced budgets were a plus, and deficits were believed to put pressure on inflation, future income tax rates, and borrowing costs, and by extension, on the strength of the U.S. economy going forward. MMT, modern monetary theory, seems to be a convenient contemporary alternative and a current-day shoulder shrug for all of that. What's your point of view?
Well, over the years, the shock value of large budget deficits has diminished as the population has become ever more dependent on government benefits, and deficit fatigue has set in. Historical evidence relating deficits to future US inflation and interest rates is not definitive, so it's possible for some economists, such as advocates of modern monetary theory, to dismiss the traditional harm done by deficits. I can't see any evidence to support that either. What we must do instead is to study the consequences of the multi-trillion-dollar outlays of COVID relief payments under Trump and Biden, the largest single factor in current deficits. This is only one incident, but its sheer magnitude gives it a great weight as a test. And it's clear that higher inflation and lower bond prices have resulted, while the growth of the US economy has weakened further. Thank you, Frank, for your thoughtful questions. We'll post another webcast on another topic in February, and I look forward to that. Thank you.